Thank you very much for joining me for this presentation. My name is Brad Renard. I'm Chief Investment Officer at QTR Capital Management and its sister company, Upside Options. The objective of this presentation is to give an overview of the broad market and review our Iron Condor Pinnacle strategy. It's currently up 20.3% year to date, and it's an optimum strategy for today's volatile market. It generates 2.5 to 5% per month. What we'll address in this presentation: how do the major charts look and what are they telling us? How's the economic data looking? What are the probabilities of this market going lower? And where will this market most likely find support and stabilize? How is the Federal Reserve impacting the markets? What are the best investment strategies for the second half of 2019, such as a non-directional strategy like our Pinnacle strategy, which is focused on writing index credit spreads and iron condors, or buying stocks and ETFs. And also, we'll review a recent trade that we opened for the Pinnacle strategy, and we'll show the risk-reward graph for the trade. I'll just cover a few slides on our company, and then I'll jump into the market overview. The available strategies that we offer a non-directional income generation strategy and long-short quantamental strategies that blend technical, fundamental, and quantitative analysis. We have a big cap growth, so we're buying stocks with strong technical and fundamentals with a market cap of greater than 10 billion. We have a small and mid cap growth where we buy stocks with strong momentum with a market cap of 250 million to 10 billion. We have a contrarian strategy where we buy stocks that have been out of favor for 6 to 12 months and are starting to recover. We have a sector rotation strategy where we concentrate on the strongest stocks within the strongest industry sectors. Then we have the Iron Condor Pinnacle strategy. So that's a non-directional, income-generating, conservative, all-weather strategy. So we're writing credit spreads and iron condors against the S&P 500 index, and that traditionally generates 2.5 to 5% per month. And we have free trials available. Please go to www.upsideoptions.net/free-trial. Our differentiation: we have a 4-level quantamental analysis where we blend technical, fundamental, and factor-based quantitative analysis. We hedge our portfolios, and we plan to open continuously running options-based hedges in each of our portfolios within the next month. And our approach to hedging is unique, where the cost to maintain the hedges is minimal. And we follow strict exit rules. So we're able to let most winners run, and our exit rules are fast enough to lock in gains to protect capital. So for example, in October 2018, we went from 75% allocated to 15% allocated in about 6 days. And if you recall, in October 2018 through December 2018, the market ended up correcting by over 25%. And for our strategies, we finished 2018 up plus 18 to plus 25% gains, and the benchmarks ended up closing down for the year minus 8 to minus 12. Our differentiation on the 4-level quantamental scanner: step 1, we do a macro analysis, big picture, technical, breadth, fundamental, sentiment, and that modulates our bullish and bearish exposure levels. Step 2, we do a technical scan, and we're finding high probability setups. So we're usually scanning about 5,000 stocks, and then coming up with a shorter list of about 200 to 300 stocks that we look at really closely. Then we do a fundamental screen, where we're looking for strong or weak companies. Strong companies, of course, for the bullish trades. Then we do a quantitative screen for probabilities of a pattern following through. This is basically linear regression analysis, and it provides a probabilistic views of the stocks that we are considering. And then finally, we use technicals to trigger our entries and our exits. Okay, big picture of the current market. Where do we stand? The market is fairly priced right now, trading around 17 times forward S&P 500 earnings. The U.S. economy has been slowing a little, and the global economies have been slowing a lot more. Corporate earnings have slowed, so we have flat growth for Q1, and we're on track for flat growth for Q2 of 2019. But earnings were really strong in 2018, so it's not surprising that we've paused on earnings growth in 2019. The headwind that will keep the SPX most likely below its all-time high of 3026 are the following. Newest tariffs on China on the final 300 billion in trade. So this is relatively new. In the last couple of days, the market has pulled back in response, and this is a big deal. So these new tariffs pretty much put tariffs on all 600 billion of imports that come from China, and this will impact the U.S. economy. We have continuous political uncertainty that can sell off stocks at any time. We have negative surprises on the economic data. So Citibank Economic Surprise Index, for example, has been trending down for the last year. And the yield curve. is still flattish and was inverted. So that tells us that the bond market still projects a slowing economy for 2019. And for the tailwind, that puts a floor under the market. The tailwinds are a dovish Fed lowering interest rates as needed. Recent jobs report was good. We have a tight jobs market and we're at full employment. We have low interest rates and low inflation, and that's good for stocks. And the consumer is still strong and spending, and that represents 70% of the economy. And most analysts and economists project 2% growth for 2019. So overall, the economy is doing okay. Going into recession is a gradual process, not an event. It takes many quarters to unfold. And as a reminder, when recessions hit, they usually cut the stock market by minus 30 to minus 50%. Right now, based on what the Fed has done, where they completely pivoted and they've gone dovish, they've recently cut interest rates by 25 basis points, and they most likely will cut rates again. We probably won't see a recession for at least 9 months to a year, pushed out to late 2020. And we have a volatile market that's been difficult to generate consistent positive gains using stocks, ETFs, or indexes. Let's take a look at the charts. Here's the S&P 500 index. This one goes from 2015 to the present. We can see how the market was really choppy prior to the election. Here's when Donald Trump was elected. Market trended up about 25 to 30%. Peaked in January of 2018. We had our first correction. 9 months later, we had another correction. And recently we broke out to all-time highs, but then that was immediately stopped from the most recent tweet from Trump about adding new tariffs. Looking at the S&P 500 zoomed in a little bit, we have a 13-day moving average, exponential moving average. We have a 50-day moving average, and here's the 200-day moving average. And we can see that the SPX actually closed right at 2930, representing this high over here. So 2930 is the breakout level. So that's actually good news that it closed above 2930. The bad news is it closed below the 50-day line. So we won't know until Monday to see if we're going to find support here or if we're going lower. And if we're going lower, then there's a pretty good chance we're going to test 2872, which is the next level down, and that represents the January 2018 high. Next chart is the NASDAQ Composite. This has about 2,400 stocks in it. We can see that this one did fail below breakout of 8,110 and closed below the 50-day line. So that's not great news, and that could motivate more sellers to enter the market on Monday, where we could fall farther, maybe Monday, Tuesday, possibly by Wednesday we might stabilize. NYSE Composite, this one was looking good. I mean, initially for 18 months, this actually was creating a pretty bearish chart pattern. This is called lower highs. So this is a downward sloping line here where we have lower highs and lower lows. And that is a very bearish pattern. 3 weeks ago, we actually broke up through that pattern and pushed up against this resistance level of 13,246. So that was actually a major positive. But now with the most recent tweet from Trump on tariffs, we're back down in this channel. So it's too soon to tell if this is going to stay down in this channel and even go lower, basically reactivating this bearish pattern, or if we're going to be breaking back up through and push up here again. So we just don't know. We'll have to spend a week watching this. Here's the IWM. This is the Russell 2000 Small Cap Index. Right now it's sending a neutral signal. Some people would say that this is more bearish. I'm looking from what I see, it's over the 200-day line, downward sloping 200-day line, so that's not good. It just needs to break over 160. If it can get over 160, it will validate that cash is flowing into stocks and that it validates an overall uptrend of the market. But this Russell 2000 index, IWM is basically the ETF that tracks it, has just been sideways and choppy, and small caps have not done much of anything. So what's the best strategy with these volatile charts? Stock picking can still work. There's always something going up. It takes a lot of experience and time. You should follow strict exit rules, and you can get easily chopped up in this market. A non-directional option selling strategy should work well for the second half of 2019. And Pinnacle is our non-directional, income-generating, conservative, all-weather strategy. It's optimized for the new political era where stocks can sell off at any time. And capital preservation and safety are a top priority. And the way we do this is we hold a maximum of 3 positions. So we allocate 30% of the cash. That provides us sufficient cash to maneuver and adjust through periods of high volatility. The Fed is lowering rates now. They're more dovish. That puts a floor into the market and lowers volatility. There's a low probability now that the SPX is going to break back above 3,026 for many months. And that's a good thing for this strategy, where we like indexes that trade range-bound. This strategy typically generates 2.5 to 5% per month, and that we can do that as the market trades sideways, choppy, and range-bound. This strategy is conservative by construction, so it allows us to sleep well at night, but it's still able to generate excellent monthly returns. It generates cash flow for people who desire monthly cash flow, and the strategy is up 20.3% year-to-date after commissions. Here's just a screenshot from our website, and it just shows the returns for 2019. Most of the returns fall within the 1 to 5% range. So we're up 20.3% right now. So let's talk about a recent trade. So we just opened this trade up yesterday. Here's the S&P 500 index, and we can see that it closed right at 29.30. So that does increase the probabilities that maybe the selling is over, but I just don't know. We'll see on Monday, Tuesday. So if you had an ugly Friday, then many times Monday will be even an uglier day. So we could come down and try to test 28.72. So we sold the August 16th 28.30 put. The 28.30 put is the short put that we sold, and it's down near this 28.10 support level and getting close to the 200-day line. We bought the August 16 28.20 put. So we sold the 28.30 put, and we bought the 28.20 put for protection. And the nomenclature would look something like this: SPX, August 16, 28.30, 28.20, bull put spread. So we're doing it on the S&P 500 index. The trade expires on August 16th. This is the strike price that we sold, the 28.30. This is the strike price that we bought, 28.20, for protection. It created a 10-point wide spread. It's bull put spread. A bull means we want the index to stay above this short put. So it's a bull put spread. So it's a 10-point wide spread. The broker holds $1,000 of maintenance to allow us to open that trade. The spread brought in a credit of about $1.25, or after commissions, about $110 into the account. We open quantity 2, and we do it twice monthly. So I'm just showing an example of opening quantity 2. So that's just using 20% allocation, not even 30%, but just 20%. So if we open it twice monthly and we open quantity 2, we're bringing in about $440. For a $10,000 portfolio, 440 divided by 10K is about a 4.4% return. And again, I'm just showing this trade for a 20% portfolio allocation. If we do it 3 times, quantity 3, and try to do it twice a month, then we're getting close to about $600 of premium that we're collecting. And then if the index falls and comes down and starts breaking below 28.30, then we'll have to move the trade, and we can adjust the trade. So that's the trade that we opened. And now I'll show you what the risk-reward graph looks like. So here's the trade, SPX, August 16, 28.30, 28.20, bull put spread. And here's half of the risk graph. So let me show you this half first. So this is basically dates on the bottom, time down here, March of 2019 through July through present. Here is the stock price, and in this case, it's the S&P 500 index, SPX. And we can see this blue line here, and this represents where the SPX closed on this date, so August 2nd, and it closed at 29.32. The color portion here represents standard deviation. This is a one standard deviation channel and a 2 standard deviation channel, but I'm not going to get into that for this presentation. So let's add one more piece to it, and this is the risk-reward graph of the trade. So this graph represents this trade. This is a 2-legged trade. We sold the 28.30 put and we bought the 28.20 put August 16th on the SPX. So the bottom represents profit. Anything to the right of this vertical line represents profit for the trade. Anything to the left represents a loss for the trade. And the vertical or the y-axis represents the stock price. This is the SPX. And this line comes all the way across, so that's where the SPX closed when I opened up this trade on August 2nd. The line we really care about is just this line right here. So at expiration, this is what your profit and loss graph looks like. And as long as the index stays above this point here, you're in profit. So you're to the right of the line. This represents the premium we collected when we first opened the trade. So when we first opened the trade, we brought in about $125, and that's what this represents. And as long as the SPX stays above this short put, and this represents the 28.30 put that we sold, and this point represents the 28.20 put that we bought. So again, as long as the SPX stays above this point, at expiration, we keep the premium that we collected. If it starts breaking below, we start going into a losing territory of the trade. and then that's when we adjust the trade. So this is a risk-reward graph of this option trade, and this is a bull-put spread risk-reward graph. Where is this market going next? Well, the market could go lower early next week before it stabilizes. We'll see. Mondays sometimes are ugly, and then the market stabilizes by Tuesday or Wednesday. So we just don't know until we get to Monday. If the China trade war grinds on, it will continue to slow U.S. and global growth. So on the negative, we have earnings growth has slowed. We have a trade war, and now it's just exacerbated again with the most recent tweet from Trump. And the bond market is pointing to a slowing economy with a flat yield curve. On the positive, jobs growth and the strength of the consumer is strong. Interest rates and inflation are low. The Fed is ready to lower interest rates again, if needed. And we have the Powell put. That's basically the Fed willing to lower interest rates, and that puts a floor under the market. So the SPX will probably trade range bound between 2872, that's the January 2018 high, and that could be the level that's tested on Monday or Tuesday of next week, and 3026, the all-time high. And it could stay range bound between these two levels for many months. And a range bound market is optimum to write credit spreads and iron condors. So thank you very much for your time. And to view our weekly analysis, and that's free, you can actually get that delivered to your inbox each week if you want it. It's at upsideoptions.net/weekly-market-update. We also have free trials available for all of our strategies, upsideoptions.net/free trial. Thank you very much for your time, and I'll see you next time.